And welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today we are going to be analyzing ASML stock. I'm going to be looking at the US ticker. This one came in by request down in the comment section of one of my other videos. If you have a stock you would like me to take a look at here on the channel, just put it down in the comments section and I will make a video. Usually I only post stocks that are in the S&P 500 for free on YouTube, but I'm going to go ahead and do ASML since it's a pretty big company and it's not anything like super kind of intricate that I need to do. It's pretty straightforward as a cyclical for me. And I haven't done very many cyclical stocks lately, and since this is a Cyclical Investors Club, I thought this might be a pretty straightforward one to just kind of take a look at for everybody. So I'm going to go ahead and put this one out on YouTube. Usually if it's a stock that's not in the S&P 500, I post those on Patreon and in the full Cyclical Investors Club service over on Seeking Alpha. I'll have links down in the description for that. There is a free tier level over on Patreon now, and I'm going to be adding more stuff to that as well. Sometimes I'll post things there that maybe I don't post everywhere else. And then if you do join the $5 tier Patreon, you can get a big discount if you ever decide to join the full Cyclical Investors Club service on Seeking Alpha. And that's where I have all the spreadsheets and everything that you often see me using on the channel. I actually had not been tracking ASML yet, even though I probably should have. So thanks for the request. I'm doing that now. Definitely high quality business that I should be keeping an eye on. As always, this is not individual investing advice. This is just how I analyze stocks. So let's look at ASML's earnings history. We can see that actually earnings were negative in 2004. That would be going back right here. And then they went fully negative again during the Great Recession in 2008-9. Shrink this down so we can see those. So negative earnings, fully negative earnings, but a quick bounce back. This along with the fact that we know that their semiconductor equipment manufacturer makes me place this as a probable deep cyclical stock. Because the earnings, if they're falling more than 50% during recessions, then that's usually enough to qualify it. And then just knowing the industry that they're in. Now, usually these aren't quite as cyclical as an actual pure semiconductor business. But we had this huge drawdown here, and then in earnings we saw they fell like 25% in 2013, 2012. More recently, they haven't been as deep. So really what we have here is a combination of secular growth and cyclicality. So we get these little years where earnings fall, although they haven't fallen very much. Of course, we haven't had like a deep recession either. So the underlying secular growth is making the business earnings become less cyclical. Let's take a quick look at the basic earnings too. So they aren't too much different, a little bit deeper, but really pretty much the same. So not too much to see there. We'll just go back to the normal view. So, but we've also had these huge price rises. Now, one thing I would say is you probably don't want to pay too much attention to the PE ratios because knowing these earnings can fluctuate a lot, especially when combined with secular growth, it makes it really hard to kind of estimate what earnings are going to do in any given year. They can rise and fall a lot, and then expectations can, almost because of the secular growth, they can get overdone a lot, and that can create a lot of volatility in the price of the stock. So usually what I do is, and I'm going to do it here, is look at the historical drawdowns that the stock has experienced. So I went through and these are just rough estimates. I didn't do exact ones. Once I get this to refresh here. Okay. So when I looked back at some previous drawdown periods, the 2000 era one was like 90%. That was really big coming off like the internet bubble. 2008 was like 65% off the high, and then 2020, in this case this is actually 2022. it fell about 55% off its high. So probably this big one isn't going to happen because that was just kind of a unique thing, even though these stocks are pretty expensive. I think the secular growth demand is just going to put a floor under this soon at a higher price relative to what it has in the past. So this kind of 50 to 65% drawdown is probably what I would expect. The deeper one, if there is like a really true economic recession going on. And then the more 50% level, more like what we saw in 2022, where it was just kind of a bust coming off of a boom, more like a stock trading thing, combined with a little bit of earnings weakness. So there's probably going to be a couple entry points for this one for me. One, about 50% off the high. And then another potential entry point, if it turns out to be a little deeper than, if it's like a real recession at the same time or something else bad happens, you could get that 65% level or deeper. And I would consider adding an extra position at that point. So right now I'm just looking to buy if it's 50% off the high, which the high is 958.40 on the US listed stock. So it would need to fall like 46% still. If we go back and look at the fast graph, it did that just 2 years ago or whatever, 3 years ago, during this decline, which I have marked as 55. Yeah, so 56%. And we already made new highs here. So I think this type of high that we see here is pretty similar to the type of high that we saw there. And we do see earnings are expected to decline a little bit and be weak. So maybe if they come in a little bit weaker, you can see this drawdown happen and you could get an opportunity to buy the stock. The idea when you buy kind of at a 50% off mark is that the market was willing to, and you could have used this if I had been paying attention. I probably could at least come close to buying this one. I don't know. I probably would have aimed a little bit deeper. I did get a couple semiconductor stocks on this decline, but I wasn't watching this one. But the way that you would think about it is, look, the market was willing to pay whatever this high price was, about $900 a share. At one point, if those conditions return again, then it's reasonable to expect, as long as this wasn't like a super bubble, which it might have been on the borderline of being, but as long as it didn't occur, it wasn't like a big, huge bubble, then we can expect that, within 5 years or so at the latest, the stock price will probably recover to that point if that secular growth to earnings is still there underneath whatever the bad stuff is happening. And that kind of happened. I mean, if you would have bought it maybe about 50% off the high, held it a couple years, it's not even a couple years, but then you get your 114% return. So if I was going to buy this stock, if we get another little dip like that, well, it's not, for most people, that's not a little dip, but when I'm used to dealing with cyclicals, that's just normal, right? So if it falls 50% and I came in and bought it, I'm really looking forward like 2 to 5 years, kind of depending on what the macro and everything else is doing, depending on if anything bad happens. In this case, it was a very quick recovery. It took less than 2 years because we didn't have a recession. Now, if we would have had an actual recession at the bottom of this, that's when it could go deeper, and then maybe you can get a chance to buy again, and you have a double position. So I usually take 1% weighted positions because typically if this is falling, there'll be a bunch of other ones, like Texas Instrument and other actual semiconductor stocks. And you can kind of spread those bets around in case with any individual one if something bad happens, right? So, yeah, I think at 50% off the high, actually, I might have marked that high price wrong. Let me see here, because I had 994. It's saying it was higher than that. That might have just been intraday. Oops. I'm just going to take a peek at this really quick. Yeah, 990. It says 1.1, but I haven't seen that anywhere, so maybe that's just like a blip up. I'm still going to use this, we're looking still at like $500 a share, I think. Let's see what I had. Yeah, a little under 500. I think that's pretty reasonable here. Now, if it goes on to make new highs, that will be adjusted. So if it does get up to 1.1K, which this doesn't have specific dollar amounts on the fast graph here, then the buy price will raise accordingly to the high, whatever new high price that it makes. So it will be adjusted if they go on to make new highs. But yeah, the idea is you buy at a 50% discount, you hold it for about a 100% return. Usually that takes at least a couple years. And so, but if it takes 5 years, you're still making 15%, which is a really good return. So you can just buy it. Sometimes they keep falling deeper. You just sit through it and wait to see if you can get your 100% return. And if you do buy a second time at down 65%, now you're looking at more like a 300% return or something like that, or 200%. And it's kind of really that simple. There's a lot of people will try to predict earnings in the short term and things for companies like this. It's very difficult to do. The short-term movements are also very finicky. So as you saw, this literally 55% decline here wasn't predictive of where the stock would be in 3 years, which is actually higher than the previous peak. So the market didn't really know. It thought things were going to be a lot worse than they actually were. And they actually came back and grew earnings 41%. And so just like with the decline that's happening now, the market doesn't really know short term, I don't think, what any of this is going to amount to. But you do know when things are really negative. That's my theory. So when it's down 50 or 60%, you know things are negative, and so you know your bias is that you have a good chance that you're getting a deal unless things like completely fall apart over the medium term and not just the short term. We know things are going to be bad over the short term. So you just have to look at what it's done in the past. Maybe think about the underlying growth trend. If there's something that interrupts that, then maybe you hold off. But as long as that growth trend's still there, it's probably going to keep going and have another upcycle in a reasonable amount of time. And then you'll be pretty good. So that's how I approach these deep cyclicals. I'm going to be watching this one now. And hopefully you found this useful. This doesn't work for every single cyclical stock, but you want to find the high quality ones. You want to find them if they do have a deep decline, you want a quick recovery, which these guys have. Preferably you want a long-term growth trend. And if you get really fortunate, you can get these, really secular growth that underlines the cyclicality. And that's what you have here. It makes it hard to buy them cheap. Got an opportunity here, and usually you get them again, but you never know. So I wait, I watch as many as I can, and I'm not afraid to buy when they do fall, no matter what the news or anything says. I just ignore it. All right, so if you found this helpful, hit the subscribe button. If you have a request, drop it in the comment section. I'll see everybody later. Bye.